Imagine this. You enter a trade with confidence. You have checked the chart. You have analyzed the trend. You have placed your stop loss. Everything looks perfect. And then suddenly, the market moves against you. Your stop loss gets hit. You lose money. And now your mind says, I need to recover this loss. So you take another trade. That trade loses too. Now you're angry. You increase your position size. You enter another trade without a proper setup. And before you realize it, a small loss has turned into a much bigger loss. This is one of the biggest dangers in trading. It is not always the market. It is often our reaction to the market. And that is exactly what we are going to discuss today. In this video, we will understand trading psychology, how to control emotions after a losing trade, how to stop revenge trading, and most importantly, how to avoid overtrading. If you are a beginner trader or even an experienced trader who sometimes struggles with emotions, stay until the end because these simple rules can completely change the way you approach trading. What is trading psychology? Trading psychology is basically the way your mind and emotions influence your trading decisions. Two traders can look at exactly the same chart. They can have the same entry price, the same stop loss, and the same target. But their results can be completely different. Why? Because their psychology is different. One trader accepts the loss and moves on. The other trader becomes emotional and tries to recover the money immediately. That second trader is no longer following a strategy. They are trading their emotions. And this is where things can become dangerous. Trading involves uncertainty. You can analyze the market perfectly and still lose a trade. That's normal. The goal of trading is not to win every single trade. The goal is to follow a good process consistently and manage risk properly over a large number of trades. Once you understand this, losing trades become easier to handle. Why does a trading loss feel so emotional? Let's be honest, losing money doesn't feel good. When you lose Rs 1000, Rs 5000 or Rs 10,000, your brain naturally wants to get that money back. You may start thinking, the market owes me. But the market owes you absolutely nothing. The market doesn't know that you lost money. It doesn't care about your previous trade. It doesn't know whether you are a beginner or an experienced trader. Every new trade is a new situation. The problem starts when we carry the emotions of the previous trade into the next one. For example, you lose Rs 2,000 on trade number 1. Instead of accepting the loss, you immediately enter trade number 2 because you want to recover Rs 2,000. Now, your reason for entering the trade is not the setup. Your reason is the loss. That is a major psychological warning sign. The most dangerous emotion. Revenge. Trading. Revenge trading happens when a trader takes a new trade mainly to recover money lost from a previous trade. It usually sounds like this. Just one more trade. I'll recover it. The next trade will cover the loss. I know the market is going to reverse. And this is where traders often make even bigger mistakes. Let's look at a simple example. Suppose you start the day with Rs 1,000. You risk Rs 1,000 on a trade. The trade loses. Your account becomes Rs 9,000. That's manageable. But instead of accepting the loss, you decide to risk Rs 3,000 on the next trade. That trade also loses. Now you are down Rs 4,000. You become frustrated and increase the risk again. Maybe the next trade loses Rs 5,000. A small, controlled loss has now become a serious drawdown. The problem wasn't the first losing trade. The problem was the emotional reaction after it. Rule number 1, accept that losses are part of trading. This is one of the most important lessons in trading psychology. A losing trade does not mean you are a bad trader. Even professional traders have losing trades. A strategy can have several losing trades in a row and still be profitable over time. Think about it like this. A cricket player doesn't expect to score a century in every match. A business owner doesn't expect every product to become successful. And a trader shouldn't expect every trade to be profitable. Your job is not to predict the market perfectly. Your job is to manage uncertainty. When you accept losses as part of the business, your emotional pressure becomes much lower. Rule number 2, never trade to recover a loss. This rule can save you from a lot of unnecessary damage. Never enter a trade simply because you lost money earlier. Before entering a new position, ask yourself, if I had not taken the previous trade, would I still take this trade? If the answer is no, stop. That means your current decision is being influenced by your previous loss. Instead, evaluate the new setup independently. Ask, is there a valid setup? Does it match my strategy? Where is my entry? Where is my stop loss? What is my target? How much am I risking? If you cannot answer these questions clearly, don't take the trade. Rule number 3, Use a daily loss limit. A daily loss limit can act like an emergency brake. For example, you might decide, if I lose 2% of my trading capital in one day, I stop trading for the day. Let's say your trading capital is Rs1,000. A 2% daily loss limit would be Rs2,000. If you reach that limit, your trading day is over. No revenge trading, no recovery trade, no one last trade. You close the platform and walk away. This is not weakness. This is discipline. And remember, your exact risk limit should depend on your strategy, experience, financial situation, and risk tolerance. There is no universal percentage that works for everyone. Rule number 4. Take a break after a loss. Sometimes the best trade after a loss is no trade. Take a 5-minute or 15-minute break. Stand up, walk around, drink some water, take a few deep breaths, and most importantly, get away from the screen. Why? Because emotional decisions become easier when you are constantly staring at the chart. You see a candle moving. You think the market is reversing. You enter. Then another candle appears. You change your mind. You exit. Then the market moves in your original direction. Now you are frustrated again. This cycle can continue for hours. A short break can interrupt that emotional loop. Rule number 5. Stop watching every tick. One of the easiest ways to become emotional is to watch every single price movement. Imagine you bought a stock at Rs500. It falls to Rs498. You become nervous. Then it moves to Rs502. You feel happy. Then it falls to Rs499. You become nervous again. This constant emotional roller coaster can lead to unnecessary decisions. If your trade is based on a proper setup and your risk is already defined, you don't need to react to every tiny movement. The market will move. Your job is to follow your plan. Not every candle needs a reaction. How to avoid overtrading. Now let's talk about another major problem. Overtrading. Overtrading means taking more trades than your strategy or plan actually requires. More trades do not automatically mean more profits. In fact, more trades can mean more mistakes. Imagine a trader has a strategy that gives 2 or 3 high-quality setups in a day, but the trader feels that they need to make money every hour. So they start taking random entries, a breakout that isn't confirmed, a reversal without confirmation, a trade based on a Telegram message, a trade based on someone's YouTube prediction, and eventually the trader's results suffer. The solution is simple. Trade your setup, not your boredom. Create a trading checklist. Before every trade, use a checklist. For example, is the market condition suitable? Is this my setup? Is the entry clear? Is the stop loss defined? Is the target defined? Is the risk acceptable? Is the risk to reward ratio reasonable for my strategy? Am I entering because of a signal or because I want to recover money? Am I calm right now? If you cannot answer these questions, don't trade. A checklist removes some emotional decision making from the process. Don't increase your position size after a loss. This is another dangerous habit. Some traders use a simple idea. I lost Rs1,000, so I'll risk Rs2,000 next time. If I win, I'll recover everything. This sounds logical, but it can quickly become a disaster. What happens if the second trade also loses? Now you are down Rs3,000, so you double again. Then another loss comes. This is essentially chasing losses. Instead, keep your position sizing consistent according to your risk plan. A losing trade should not automatically make you increase your risk. Use risk management to reduce emotional pressure. Good risk management and good trading psychology are closely connected. Think about it. If you risk 20% of your account on one trade, even a small market movement can create enormous emotional pressure. But if your risk per trade is small enough that you can comfortably accept the loss, you are much more likely to follow your strategy. This is why many traders focus on protecting capital first. If you protect your capital, you give yourself the opportunity to stay in the game. And in trading, staying in the game matters. The power of the trading journal. If you want to improve your psychology, start keeping a trading journal. After every trade record, the date, the stock or instrument, your entry, your stop loss, your target, your position size, the result. And most importantly, how were you feeling when you entered the trade? Were you confident, fearful, angry, bored, trying to recover a previous loss? Excited because you had just made money? Over time, your journal can reveal patterns. Maybe you discover that most of your losses happen after 2 consecutive winning trades. Maybe you discover that you overtrade after a loss. Maybe you discover that your best trades happen during the first part of your planned trading session. The journal turns emotions into data, and data can be analyzed. Learn to recognize your emotional warning signs. Every trader has emotional warning signs. You need to identify yours. Maybe you start increasing your position size. Maybe you start entering trades faster. Maybe you stop using stop losses. Maybe you start moving your stop loss further away. Maybe you keep refreshing the chart. Maybe you start thinking, I have to make this money back today. These are warning signs. When you notice them, don't ignore them. Stop. Step away. Review your plan. Sometimes the best decision is to finish trading for the day. Don't let one bad trade become a bad day. Here's a mindset shift that can make a huge difference. A losing trade is an event. It does not have to become your entire day. Suppose you lose Rs 1,000. You can say, I lost Rs 1,000 on this trade. Was the trade executed according to my plan? If yes, learn from it and move on. If no, identify the mistake. But don't turn that one loss, revenge trade, more losses, emotional breakdown. Instead, make it one loss, review, learn, reset. That is the difference between emotional trading and disciplined trading. What should you do immediately after a loss? Here's a simple 5-step process. Step 1. Accept the result. The trade is finished. Don't argue with the market. Step 2. Take a short break. Step away from the screen. Step 3. Check the trade. Ask, was my entry according to my strategy? Did I follow my stop loss? Did I follow my position sizing rules? Step 4. Reset your mind. Forget the previous trade. Treat the next opportunity as a completely new decision. Step 5. Trade only if the setup is valid. If there is no setup, there is no trade. You don't have to trade every day, and you certainly don't have to trade every hour. A simple anti-overtrading rule. Here's a practical rule you can consider. Set a maximum number of trades per day. For example, you might decide that you will take no more than 3 trades in a session. The exact number should be based on your strategy. Once you reach your limit, stop. This creates a boundary between disciplined trading and emotional trading. But remember, a maximum trade limit is not a target. If your strategy gives you 0 valid setups, 0 trades is perfectly fine. Don't confuse activity with productivity. This is a mistake many new traders make. They think if I'm not trading, I'm not making progress. But that's not true. Studying charts is progress. Reviewing your journal is progress. Backtesting your strategy is progress. Learning risk management is progress. Waiting for a high-quality setup is progress. Sometimes the most professional decision you can make is to do absolutely nothing. No trade can be a successful trading decision. Your goal should be consistency, not excitement. Trading can be exciting. Green candles, big moves, fast profits, sudden reversals. But excitement is not the same as profitability. A professional approach is often boring. You wait. You analyze. You enter only when your setup appears. You manage risk. You exit according to your plan. Then you wait again. The market doesn't reward you for being busy. It rewards you only when your decisions work over time. Think in probabilities, not certainties. This is another important psychological shift. Don't think this trade will definitely go up, as instead think, based on my strategy, this setup has historically offered a reasonable probability of success. But the outcome of this individual trade is uncertain. That small change in thinking can reduce emotional pressure. Because now, a loss doesn't mean your analysis was necessarily useless. It simply means this particular outcome was a losing outcome. Trading is a probability game. What if you lose several trades in a row? Let's say you lose 3 trades consecutively. Your first instinct might be, my strategy doesn't work. But don't make a decision based on 3 trades. 3 trades are a tiny sample. Instead, evaluate your strategy over a much larger sample according to your trading plan. Review dozens or hundreds of trades where appropriate. Look at win rate, average win, average loss, risk to reward, maximum drawdown, execution quality, and whether you actually followed your rules. The goal is to evaluate the system objectively rather than emotionally. The golden rule of trading psychology. If you remember only one thing from this video, remember this. Never make your next trading decision because of your previous trading result. Your previous trade is finished. A profit should not make you overconfident. A loss should not make you revenge trade. Every new trade deserves a fresh analysis, a simple trading psychology routine. Before the market opens, spend a few minutes preparing yourself. Ask, what is my trading plan today? What setups am I looking for? What is my maximum acceptable loss? How many trades am I allowed to take? What will make me stop trading? Then during the session, follow the plan. Avoid impulsive entries. Don't chase the market. Don't increase risk emotionally. And after the session, review your trades. Record mistakes. Record good decisions. And identify emotional patterns. This simple routine can make your trading much more structured. Trading is not just a battle against the market. In many cases, it's a battle against your own impulses. Fear can make you exit too early. Greed can make you hold too long. FOMO can make you enter late. Anger can create revenge trades. And boredom can create overtrading. You cannot completely remove emotions from trading. You're human. But you can create rules that prevent emotions from controlling your decisions. Accept losses. Use predefined risk. Avoid revenge trading. Set a daily loss limit. Take breaks. Use a trading checklist. Maintain a journal. Limit unnecessary trades. And most importantly, remember that capital preservation comes before profit chasing. The market will be there tomorrow. You don't need to win back today's loss today. Sometimes, the smartest thing a trader can do after a difficult session is simply close the charts and walk away. Because successful trading isn't about winning every trade. It's about making disciplined decisions again and again over the long term. If you found this video useful, share it with someone who struggles with revenge trading or overtrading. And if you want more practical videos on trading psychology, risk management, technical analysis, and stock market basics, subscribe to the channel. Remember, control your risk, control your emotions, control your trades, and never let one losing trade control your entire trading day. Thanks for watching, and I'll see you in the next video.